Why the South African Reserve Bank's Monetary Policy Committee should not cut interest rates tomorrow, even though the bond market is forecasting a cut in interest rates. Are you one of those economists in consensus that we won't see any cuts tomorrow?
Yes, we don't think they'll cut rates tomorrow, basically because, as Kevin said, of the forward-looking nature of the SARB. That obviously assumes that they are consistent in the way that they sell their decision. And in particular, while we agree the growth momentum is improving, the forward-looking nature is particularly important with regard to their long-term inflation forecast. So, 18 months out, and it's not clear that that's sitting at close to 4.5% yet.
Andrew making the point that CPI came in at 5.7% today, back below the band, or in the band, that 3 to 6% set by the South African Reserve Bank's Monetary Policy Committee. Do you expect it to stay there, or are you saying that we're going to see it tending out of that band again?
I know we're actually quite bullish on inflation for the next sort of year and a half. We have a low point of, again, about 4.2%, and it only moves outside the target band again by the end of next year. Yet even taking into account our forecasts, we still don't think the SARB should be cutting rates at this point. Rather, sort of our advice to the SARB would be to stay at 7 for as long as possible, create some stability in terms of expectations, because again, it is important, the signal that a first rate hike would send, given that in the past you had quite significant tightening cycles, and that's sort of embedded in the consumer psyche. So once the SARB starts hiking, they expect a significant increase in interest rates, and that would then have a negative impact on growth because of decline in consumer confidence down the line.
So what you're saying from here, sideways, and then we can potentially expect a hike out of the South African Reserve Bank. How soon are you expecting that hike?
At this stage, we're expecting it only by the end of the first quarter of 2011, and even that may be pushed out because of two factors really. One, again, the Fed is in no hurry to tighten rates, and we think the Fed actually tightening rates may be a trigger for the rest of EM who have not yet tightened to follow. And the other is that the rand's quite strong, and that particularly with regard to your export and manufacturing sectors, the rand serves to tighten monetary conditions. So that sort of would take the pressure off the Reserve Bank to do the heavy lifting. The flip side is that a strong rand tends to be very good for the domestic economy. So thinking about the consumer, the retailers, fixed investment importers. And then, the SARB then is in a difficult position because inflation may stay lower for longer, yet growth may be much stronger than many people expect.
Carmen, appreciate that update from your front. That was Carmen Nel, Senior Economist at Rand Merchant Bank, joining us from our Cape Town studio. Coming back, do you think an interest rate hike first quarter 2011? Is that what you're forecasting?
That actually is what we're forecasting.
Oh, surprise, surprise. The economists are in consensus.
We changed notes before the show started. But I think the important message with that is that you're looking at rates staying on hold for a considerable period of time. In other words, to only hike in the first quarter next year, that's saying that the rates are going to be on hold for well more than a year. And that would just be fantastic in this environment.
Andrew, I got you in here to talk about the construction sector, and specifically about your strategy around Aveng and Group 5. And I know that you started looking at the construction sector some months ago in terms of value, and it's a debate that has been raging on the financial news desks as to when these construction stocks are going to start offering value.
Yeah, well, if we look, 3 years ago, the whole rage was construction stocks. Everyone wanted them, be it from Wilson Bailey Homes to Aveng to your small counters. What have they done over 3 years? Flat, down at best.
And you weren't touching them 3 years ago?
3 years ago, we didn't touch them. It's called herding, I think is the word we're looking for.
Hold on. We have to interrupt here.
Yes, okay.
That paints a picture that was a straight line, right? That we moved from A to B in a straight line and there was no money to be made. That's nonsense. The art with that was not to say, listen, I'm going to buy these things and hold them forever. It was recognizing that a theme came into play. That theme was very powerful in terms of the infrastructure story. That theme drove the stocks a lot higher, and at some point those stocks became potentially overvalued, and obviously sitting on
and there was no more money to be made for 3 years until they came off dramatically.
That's right. So it is a question of stock rotation or sector rotation, and you have to be aware of that. It's not a question of just buying a sector and then holding it from A to B.
3 months ago you thought construction stocks, and I may have the timing wrong, construction stocks were looking cheap.
They were, and they still are looking cheap. 2006, they're trading on PEs of 20 and above. Today, we've seen them, most of them below 10. Avenge, for example, trades on about a PE of 6, with a market cap of 15 billion and about 8 billion on cash on the balance sheet. That's very attractive for us. Group 5, likewise, also very, very cheap, trading on a PE somewhere around 5, 6.
So still at these levels,
still at these levels, at these levels today. And the infrastructure spend, it's still there. I think it's 850 billion over the next 3 years. If you look around sub-Saharan Africa, I think there's about 22 billion US dollars a year being spent on infrastructure. These companies are exposed to that. It's not the end of the pipeline that the World Cup's upon us.
Can I add something, or are you going
somewhere
somewhere
else?
Yes,
you can. I'm going to introduce Khad in just a moment, but
okay,
you can add something on the construction.
2 minutes of Khad's time,
absolutely.
30 seconds. The issue with the construction is that the underlying rationale for the construction stocks has not changed, in the sense that the infrastructure spend has been there, the government has been committed, they've upped their infrastructure spending every year since that program started. After the World Cup, the infrastructure spend remains in place. That thought, which is a pure economic thought, has not changed. What has changed is the valuation around that. And at some point, yes, it came into favor. There was a herd mentality. Stocks ran up and it became overvalued. Then people panicked and got out of it. And now they're looking, now there is a lot more interest in the construction stock. I need to stress the underlying economic theme has not changed. It's the valuation around that that has oscillated. And now they're coming back into favor.
Can I introduce Khad now?
Yes, ma'am.
Joining us now is Khad van der Linde from the Institute of Behavioral Finance. Thank you very much for your time. And you're here to talk to us about the Sanlam Investment Management Investor Confidence Index. Can you tell us this time around what we're seeing on the paper?
For the first time in 6 months, which is I think something positive, we see the financial planners, and we've got two groups of participants. The one are what we call institutional investors, and they consist of economists and financial analysts. And the other part is the financial planners. They seem to be more positive for the first time in all the different indexes that we measure. Not a lot, but substantially more than in the past 6 months. Whereas the institutional investors still think there's a little bit, they don't see value in the market as yet. So what we see is that financial planners work with clients and they pick up the sentiment from the clients quicker, and they need to, you know, when you sit across someone and you want to invest the money for 6 months,
you have
12
to be
months,
positive.
you have to be positive. You can't remain negative for
planners.
6 months, 12 months, and it wasn't keep telling people, listen, we're moving sideways, your money is not going to give you any return. So they start to see light at the end of the tunnel.
But ultimately, financial planners are talking up the market for their own benefit. Otherwise, nobody's going to put money with them.
On the other side as well, we've seen the market gaining substantially since last year in March. You know, and to keep telling
the lows in March 2009.
Yeah, it was a low, and since then they've gained a lot. But since then they've been telling people, listen, you're not going to make a lot of money, but the market was running. So I think eventually they start to think, listen, we're losing out on this momentum. Perhaps we must do something about it. It can't be that bad.
Hindsight's always a perfect science. Coming from you, Mr. Links?
Can I just ask you, in terms of the institutional investors, is there any, do you get any detail from them as to what their hesitancy is? Is it a pure valuation hesitancy that they have? Or is it much broader than that? That their outlook for the next couple of years in terms of the overall economic performance is not good? What is their hesitancy?
We only ask 5 questions, but the one is about valuation. And what we ask them is, do you think that the prices are fair, the prices are cheap, fair, and they keep telling us that they think that prices are, that stocks are expensive. The other thing that we ask people is quite short term. We ask them, what do you expect the market to do in 1, 3, 6 and 12 months? And from the institutional investors, we see a sideways movement for 1, 3 and 6, nothing more than 1% gain. For 12 months, they're prepared to perhaps think about something like 6% gain.
Do you think stocks are expensive across the board?
Well, we're a fundamental asset manager, and looking at the fundamentals, we think markets now are fairly valued. We look at what you call a Graham-P ratio, which takes the cyclically adjusted earnings into account over 7 years. And looking at that, markets right now, we say are fairly valued. Saying that though, there are opportunities within the market. If you can
and that is a discussion for another day.